If you invested $500 per month and earned 8% annually, you'd have roughly $745,000 after 30 years. That's the math most investing videos focus on. But here's the uncomfortable reality. According to the Federal Reserve's most recent survey of household economics and decision-making, over 1/3 of Americans would struggle to cover a $400 emergency with cash. Slow down. Controlled concern, not alarm. So before we talk about compounding returns, before we talk about index funds, before we talk about asset allocation, we need to talk about stability. Because investing without a financial foundation isn't strategy, it's speculation. And that foundation begins with something deceptively simple, the 50-30-20 rule. In this video, I'll show you exactly how to apply the 50-30-20 rule step by step before investing, and why doing this first significantly reduces your financial risk over time. This isn't about restriction, it's about control. The 50-30-20 budgeting rule was popularized by U.S. Senator Elizabeth Warren in her book, All Your Worth. The concept is straightforward. 50% of your after-tax income goes to needs, 30% goes to wants, 20% goes to savings and debt repayment. Simple. But simplicity is often what creates consistency, and consistency is what creates financial stability. Let's break down how to actually apply this in real life before you invest a single dollar. Step 1. Calculate your real income. The rule works off after-tax income, not your salary headline. If you earn $75,000 per year, that number is irrelevant for budgeting. What matters is what actually hits your bank account. Let's say after taxes, insurance, and retirement deductions, you bring home $4,500 per month. That's your working number. Now pull your last 3 to 4 months of bank and credit card statements. Not estimates, not guesses, actual numbers. Categorize every dollar. Most people are surprised by what they find. Subscriptions they forgot about, impulse purchases that add up, dining out costs that rival grocery bills. Awareness can feel uncomfortable, but awareness is where control begins. Step 2. Define needs versus wants, objectively. Under this model, needs include rent or mortgage, utilities, insurance, groceries, transportation, and minimum debt payments. These are expenses required to maintain basic living standards. Wants include dining out, streaming services, travel, hobbies, and upgraded lifestyle choices. Now here's where it gets practical. If your needs exceed 50% of your take-home pay, investing should not be your first priority. You may need to reduce housing costs, refinance debt, or cut discretionary spending temporarily. Because if fixed expenses consume too much of your income, your financial margin disappears. And investing requires margin. Step 3. The 20% bucket. Stability before growth. This is where most people want to skip ahead to investing. It feels productive. It feels proactive. But the 20% category serves two primary purposes first. First, an emergency fund. Financial planners typically recommend 3 to 6 months of essential expenses in liquid savings. If your monthly needs total $2,500, that means $7,500 to $15,000 set aside. That number isn't random. Job loss durations in the United States frequently average several weeks to months, depending on economic conditions. Without an emergency fund, what happens if income stops? You liquidate investments, often at the worst possible time, during market downturns. This is called forced selling, and it destroys long-term compounding. An emergency fund protects your investments from your life circumstances. That's its real function. It buys you time. And time is what investing needs most. Second, high-interest debt repayment. Let's talk math. If you carry credit card debt at 22% interest, paying that off yields a guaranteed 22% return. There is no stock market index delivering that consistently. So if your 20% allocation goes partly toward eliminating high-interest debt before investing, you're improving your financial position mathematically. This isn't emotional advice, it's arithmetic. And arithmetic doesn't negotiate. Step 4. Automate and pay yourself first. Behaviorally, humans don't save what's left over. They spend what's left over. So reverse the sequence. On payday, automatically transfer savings and automatically pay extra toward debt. Treat savings as a fixed bill. This method is commonly referred to as pay yourself first. It removes willpower from the equation. And systems are stronger than motivation. Because motivation fluctuates, systems do not. Now let's address reality. In high-cost areas, 50% for needs may feel unrealistic. That doesn't mean you've failed. It means you adjust. You might start with 60% needs, 30% wants, and 10% savings, and gradually shift as income increases or expenses decline. The key is intentional allocation. Without structure, spending expands to fill income. Economists call this lifestyle inflation. When income rises and spending rises proportionally, wealth stagnates. Budgeting contains that expansion. It protects future you from present impulses. Now, let's connect this to investing discipline. Markets are volatile. Historically, the S&P 500 has averaged roughly 10% annually before inflation over long periods. But in individual years, returns can swing dramatically. If you're financially stretched, a market downturn feels catastrophic. You panic. You sell. But if you have controlled spending, an emergency fund, and no high-interest debt, market volatility becomes background noise. You stay invested. And staying invested is what allows compounding to work. Budgeting isn't restrictive. It's protective. Before allocating serious money to investments, walk through this checklist. Calculate your true after-tax income. Categorize spending into needs, wants, and savings. Apply a structured ratio. Build a starter emergency fund. Eliminate high-interest debt. Automate savings. Review monthly. Only then does investing become strategic rather than reactive. There's a reason disciplined investors emphasize foundations. Because investing magnifies behavior. If your financial habits are unstable, investing amplifies instability. If your habits are disciplined, investing amplifies growth. The 50-30-20 rule isn't magic. It's structure. And structure creates resilience. Once you know exactly where your money goes, once you have liquidity for emergencies, once debt is under control, investing becomes what it should be, a long-term wealth-building tool, not a financial lifeline. If you found this breakdown useful, consider subscribing for more structured, research-based discussions on personal finance and investing. And in the comments, consider this question. What percentage of your income currently goes towards savings? Clarity begins with measurement, and financial confidence begins with clarity.